Let's open a put credit spread on Google. So put credit spread is a way to collect premium for betting on the direction of a stock. So in this case, it will be saying that we think that Google will increase in value in the future, which, looking from some past performance, we can see Google's doing pretty good, right? Up 67% year to date. It just keeps climbing and climbing. Of course, it could always crash. Right here, we see some acceleration back in spring of 2025. So it could easily pull back if people think it's overvalued. But I think as far as options trading goes, this could be a good one to get into. So I'm going to click trade options. The sweet spot for put credit spreads is a month to a month and a half out. That gives us enough time to collect a decent amount of premium. We're not waiting forever. And we also have some time to adjust our position if it moves against us. So to build this, we say, I think Google's going to go up. So click the green arrow going up. Scroll down to put credit spread. And the width, just pick the smallest one. And for the date, we're going to pick something in the future. So at least 30 days out, we have 32 days. And notice the width setting, I did have it selected on $2.50 and nothing's showing up. So if you notice that, you can always click on that and then change it. So in case you're not seeing any option chains, this is a way to fix that. So it looks like the earlier strike distances, those widths are more fine, where you can look at $2.50 widths, but they don't have these 30 days out plus apparently with this particular stock. So we're going to pick the smallest one and at $5, and then our option chains reappear. So we have 32 days, we could pick a 39-day expiration, we could pick 46-day expiration. So I'm just kind of, why not go in the middle, pick a balance between 30 days and 45 days. So we're going to decide on 39 days. Right now, the share price is around $3.18, and we are going to scroll down until we find a delta that looks good. So I'm looking for 5% or better. So what that means is this delta is about a 5% chance of this position moving against us. So share price is currently $3.18, and if it moves below $305, there's only a 5% chance of that happening, 5.14% chance of that happening. And if we keep going down, this is a 4.62% chance of that happening. This one's 4.08% chance of that happening. So we just have to find something that has a high probability of profit and still collect a decent enough premium to make it worth our while. So why not go to the 295? It's a nice psychological number barrier because this one's at 300, and then 295, 290 for that spread. We'll click on that one. This is a risk to reward ratio of risking $400 to make $100. That's 4-to-1, and it gives us a healthy 7.5% run there for the stock to move down. So kind of lots of room, I think. It would have to dip below psychological number of $300. So I'm hoping that with around like a 4% chance of this actually dipping below that, and also giving Google 7.5% chance, or 7.5% drop in price, that's seems like it would be enough to give us some time to adjust our position in case it moves against us. So we'll get about $100 to get into this, so we can click continue. We'll do 1, Low fill likelihood. So maybe 0.99. Will it like that? Medium fill likelihood? Sure, why not? Click review. Collateral's $500. Swipe up. Pending. Filled. Sweet. Okay, so we got roughly $100 to get into this deal. Putting aside $500 in order to, it's enough money to close it if we need to. Click done. So now we can look at this contract. We can go back, scroll down, and I think go into history. Here we go. So yeah, here's our spread. Oh, look at that. It's already lost money. So if I bought it back, or if I closed it, because I bought one and I bought a leg and sold a leg, so I'd have to undo it, sell the other, buy the other. If I close this, I would lose $4. But obviously we're not going to close it. We're going to give it some time. We are going to look at the simulate my returns. So today, if I closed it right now, I would lose $4. But you can see if Google's price stays the same or better in the future, we'll reach our max profit, which is like the premium we received to enter into the deal, which is about $100, right? So we can see if the price rises, good for us because this is a put credit spread. And if it drops, we would have to close early just to limit our losses. And you see it has to drop 7.5% before we start losing money at expiration. So that's how you set up a put credit spread, and we did that on Google. So if you like this kind of content, give me a like and subscribe, and I'll see you next time.